finance, commerce, insurance, and banking. He is having experience of over 36 years in banking and financial services with cross-cultural experience and good knowledge in the insurance sector. Sir has handled senior level responsible positions with higher level interactions and exposure. He has authored number of books, study materials for professional institutions like ICSI, ICAI, ICMAI, IGNU, IIBF, Insurance Institute of India, Mumbai. Now I request sir to start with the session.
Okay. Thank you very much, madam. First of all, thanks to ICSI, IIP for giving me an opportunity to discuss about the process of issuing a bank guarantee by the banks and how to handle the bank guarantees during CIRP process. So first 2 hours, I will discuss how the bank guarantees are issued by the bank and what are the various sub-processes and all these things. After that, last 1 hour or whatever 45 minutes are there, how to handle the bank guarantees during CIRP process. Here, the banks are providing two types of facilities to the borrower. One is a fund-based, second one is a non-fund-based business. Fund-based, again, broadly classified into cash credit or working capital loans. The second one is the term loans. Normally, bankers are giving term loans for acquiring fixed assets or construction of a production department or administrative building department or transport vehicles, etc., etc. But whereas working capital, the maximum period is 1 year only. Every year, that is to be renewed by the banks based on the performance of the companies. So at the time of sanctioning of the loans, bank will stipulate some terms and conditions. The terms and conditions are arrangement letter. Both are one and the same. So at the time of giving the loan, whether it is a term loan or working capital or whatever the bank guarantee or the letter of credit, whatever the various products that are selling by the banks to the borrowers, they will give some terms and conditions. The terms and conditions are very, very important. Being an insolvency profession, the terms and conditions copy is available with the corporate debtors, the finance department. So what type of loans they have given? What are the stipulations while sanctioning the loan? What is the primary security for the loan? What is the collateral security for the loan? Next, what is the rate of interest? All these conditions are stipulated in arrangement letter or the terms and conditions letter. The working capital or term loan, it is a fund-based advance. That's why it is reflected in the bank's balance sheet assets side. That is loans and advances. But whereas non-fund based business means banks are also offering non-fund based. They are not parking the funds. They are not giving the funds, but they will issue one guarantee on behalf of the borrower to the third party. And whatever the contract between the borrower and the third party, if at all that contract is failed, whatever the loss incurred by the third party, that will be compensated by the bank through bank guarantees. With regard to appraisal part, security part, more or less, whatever the fund-based limits they are giving, the same logic or the same process, they will extend to the bank guarantees. Even though it is only one paper or document, that is given by the bank on behalf of the borrower to the beneficiary. So that's why I will discuss in detail. So first, being a resolution professionals, whether IRP or RP, the process, first we should know the process. Then it is very easy to handle and very easy to interact with the bankers or financial creditors. The bank guarantees are contingent liabilities. It is mentioned in the footnote of the balance sheet. It is not a liability or it is not an asset. Once it is devolved, then only the contingent liability will convert it into the loan. So for that, I will discuss how we are processing the bank guarantees. Today, the bank guarantees, branches are not issuing. Branches are not issuing. In my bank or big banks, central processing centers are there. That is called Trade Finance Central Processing Center. Trade finance, whether you call it as an IDBA or call it as a State Bank of India or call it as a Punjab National Bank or Canara Bank, they established in prominent places trade finance central processing centers. So once the branch is received the application of the bank guarantee from the borrower, then they will send directly to the trade finance central processing center. Then the borrower has to go to CPC and whatever the requirements, whatever the document, whatever the security, all are to be submitted to the CPC. Then they will issue the bank guarantee. Earlier, the bank guarantees are issued in a fiscal format, like bank guarantee, the name of the applicant, name of the beneficiary, issued by bank signature, 2 signatures as per Reserve Bank of India. If at all the bank guarantee is more than 50,000, 2 officers with their names and their employee number to be mentioned. But in the bank guarantees also, number of frauds are happening. Number of frauds are happening. People are manufacturing the bank guarantees like notes, currency notes. Some people, they are in the habit of preparing the bank guarantee by signing or like bank signatures and all these things. They are submitting to the government department or contracts, whatever, whoever is asking the bank guarantee, but he will take some amount. Here, there is no margin, no appraisal, nothing. It is like a spurious note. And banks, all banks in India, we have to redesign the process. Now the bank guarantees are issued through electronic form with a digital signature and whatever the barcode, whatever it is there, the technology related areas, they will imbibe into the bank guarantees. So in India, particularly, I'm talking about my bank, that is State Bank of India. The Trade Finance Central Processing Center for across the country, they have established in Hyderabad. All banks, whether it is a Bihar or Uttar Pradesh or Rajasthan or all, it is routed through Central Processing Center that is located. Earlier, each and every circle, the TFCPC is there, Trade Finance Central Processing Center. So the bank guarantees, Reserve Bank of India regulations are there. Bank guarantees are also turn into non-performing asset. Non-performing asset means once it is devolved, bank will open the loan account and amount will be immediately given to that beneficiary. We don't talk also. Why? Because some borrowers, No, sir, that the government, they have not paid my bills, and now they devolved the bank guarantee. We don't listen whatever the borrower is told. Once the beneficiary is sent back my bank guarantee, that particular contract is not fulfilled the contract, please pay whatever the compensation amount bank guarantee issued. Please pay the amount. Immediately we will create a loan account and pay back to the this one. We don't listen. Otherwise, bank guarantees, people will not believe the bank guarantees. Once I listen the borrower, he will tell so many things. Don't pay, sir. Once I have believed or listened the borrower's words, this is the practice that are adopting by the Indian banks from good olden days to till date. So that's why I will discuss in detail. And at about 4 o'clock, we will break for 10 minutes tea break. After that, up to the 5:30, we will continue. And 10 minutes or 15 minutes before, whatever your doubts are there, I will try to clarify all your doubts. Now coming to the bank guarantees. A bank guarantee is a promise by the bank to cover the loss incurred by the third party due to non-performance or a default of its customer. Suppose I take, for example, one road contractor is there. He won the tender, 10 kilometers road, 4 lines. And the total project cost is 100 crores. And the government of, particularly any state government, now I am in Hyderabad, Telangana state government told, you have to complete the contract, particularly road project, within 2 years spans. If at all you have not completed, then you have to pay to the government by 20 crores. So you please deposit 20 crores with the government account. But being a contractor, if at all you deposited 20 crores in the government, then to complete the works, to complete the contract, the funds shortage will be there, liquidity problem will arise. Alternatively, the government of Telangana, they will ask the contractor, okay, if at all you are unable to pay the amount, you go to you bring one bank guarantee for 20 lakhs. If you are unable to complete that project within 2 years, the bank has to pay the amount of the loss to us. For that, the specimen of the bank guarantee is like that. So they will give the specimen to the borrower. Borrower will approach to their bankers, and the bankers they will require. He requested the banks like fund-based loans, non-fund-based loans. Also, some processes they will complete that process, and they will take the security. They will take the margin money, particularly cash margin, and all these things they will complete. After that only, they will issue the bank guarantee. Today it is an electronic. Bank automatically they will send to the government, concerned government through electronic. They have to open through digital signature. That process is also there. So the bank guarantee is a promise by the bank on behalf of the contractor to the government to cover the loss if the road contract is not completed within 2 years. Whatever the loss that is incurred by the government to the tune of 20 crores. In this example, the bank has given a guarantee to the government by a third party, that is government, due to non-performance or default of the customer. So my customer requested me, my customer means the borrower. A bank guarantee is a formal assurance given by the bank on behalf of its customers, committing to cover the financial loss. In this case, the 20 lakh crores is a financial loss for the government. Once 2 years elapse, If the road contract is not completed, again from the square onwards, they have to call for the tenders. In the meantime, the public will also suffer. That's why that stipulation they have mentioned in the tenders that a loss 20 crores to be paid if at all it is not completed within the stipulated time to meet the specific contractual obligations. And it acts as a safety net for the beneficiary. So it is a safety net to the government. That's why whatever the scheduled commercial banks that are registered under second schedule of the Reserve Bank of India, all state governments, they will accept the bank guarantees from the scheduled commercial banks. That is registered under second schedule of the Reserve Bank of India Act. Typically used a high value or high risk transaction where a trust needs to be reinforced. So the bank guarantees are big business in the banks also. On lending, the banks are getting interest. On bank guarantees, banks are getting processing charges plus commission on bank guarantees. Commission depends upon the based on the period of the guarantee, as well as the amount of the guarantee, as well as the security offered by the particular borrower. In some cases, the banks are insisting for 100% cash margin. In this case, that example, whatever I told, if for 20 crores, he is not a borrower, he is a new person, he is not having any the loans with us, then we will insist 20 crores. If you put deposit on the deposit, we will mark lien and issue the bank guarantee. In that case, we don't charge higher commission. Whatever the prevailing commission is there, 1/4 of the prevailing commission we will charge. Suppose the commission is 1 lakh. In this case, we will charge 25,000 only because he has given the pure fixed deposit. I need not sell. Once the bank guarantee is devolved, I can cancel the fixed deposit and pay the government. Thereby, my job will be simplified. Otherwise, if at all he is offered land or building, and if that case is under CIRP, I have to wait. And I should not sell during the moratorium period. All these things are there. That's why the banks are charging the 25% of the prevailing commission rate. It acts as a safety net for the beneficiary, government. In this case, typically the high value, high risk transaction where trust needs to be reinforced. Once the bank is given guarantee, then governments, whether it is a state government or central government, port authorities, even in companies, particularly infrastructure companies, n number of bank guarantees are there. Loans are very few. That's why I told the madam also, if at all we are giving the process in detail, first and foremost, how the banks are doing. After that, the role of the IP or IRP, the role is minimal. So that's why first we have to know the process of the bank guarantees. In simpler terms, bank guarantee refers to the bank promise. They are giving the promise to the beneficiary, the government, on behalf of the contractor, that is applicant, to step in and pay the beneficiary. If the customer defaults, customer means the applicant, in our case, the contractor. This provides financial security to third party and allows the business individuals to enter into agreement greater confidence. Today for ports, whenever they are releasing the goods, the custom authority, they will ask the payment funds. If the funds are not there, then they will issue the bank guarantee and release the goods. They will release. Otherwise, in the ports, the imports, lot of damages will happen. Not only that one, the physical documents like a bill of lading, invoice, they will send by post. And once that is delayed, in the meantime, if I have not, my company is not released the goods after they reach the destination, then if they put in godowns, damages on hourly basis have to pay. In the meantime, I will take the bank guarantee and give it to and release that one. Once I received the original documents, I will submit to the customs authorities at ports or airports in case of airway bill of lading is said. Airway bill of lading is also there. Types of bank guarantees. There are different types of bank guarantees out there. What are the various types of bank guarantees? Financial guarantee, performance guarantee, customs authority, deferred payment guarantees. Different types are there. When the IRP or RP is handling, particularly the infrastructure projects, the role of the IRP or RP is more in handling the guarantees issued by the banks. Some of the assets of the corporate debtor is structured with the bank on account of issuing the bank guarantees. And some of the amount by way of a fixed deposit structured with the financial guarantor of the corporate debtor for this bank guarantees. What is a financial guarantee? Issued to the guarantee payment in case of applicant fails to meet the financial obligation used in lieu of a upfront deposit or earnest money. Particularly the earnest money, whenever the road contracts and all these things are there or auction, the guarantees they will insist. Once they have auctioned the property, they have to ask 25%. 25% is not there, then guarantee. Not only that one, even a prospective resolution applicant also, we are insisting guarantee. So, issued the guarantee payment in case of applicant fails to meet the financial obligation used in lieu of upfront deposits or earnest money. A company provides financial guarantee to a vendor instead of depositing 10 crores as a security. Today, amount is not the criteria. If a guarantee is there, so stocks will be released, supply of stocks. Once the bank guarantee is given, okay, in case the buyer is defaulted, the seller is having full security, that is a bank guarantee. That's why the company provides financial guarantee to a vendor instead of depositing 10 crores as a security. Ensures obligation or performance of promise in a contract are fulfilled. In the earlier example, the performance of the contract, particularly the road contract of 10 kilometers, 4 lines, that is to be completed within a span of 2 years. If not, then the government will incur some loss. That loss at the time of a tender, they will mention 20 crores. You have to deposit, either deposit the amount with the government treasury or bring that particular bank guarantee from the scheduled commercial banks. If not, bank compensate the beneficiary for the loss incurred. If it is not completed within 2 years, the loss will be compensated. Performance guarantee. Contractor A fails to complete the project for company B on time. Company B recover the losses through the performance guarantee. Here, financial guarantee, performance guarantee is there. but banks are not issuing performance guarantee. The banks will ask the applicant convert the performance guarantee into financial terms. Suppose the road is to be completed within 2 years. If the contractor is not completed 2 years, bank will not start the construction of the road contract. Bank will ask, okay, if he is not completed the performance, that is the 2 years, that to 10 lines, 10 kilometers, 4 lines, then how much loss you tell me, convert the performance into financial. So in banks, we are not issuing any performance guarantees. Otherwise, it is a problem. So whatever the performance is there, finally that wordings and all these things are there in the guarantee agreement. And finally, we will ask how much loss you are going to incur. Fail to complete the project for a company B on time. That is the earlier example, 2 years. Company B recovers the losses to the performance guarantee. The government will recover the losses from the bank, that is 20 crores in the earlier example. Secures the advance payment made by the buyer to ensure the delivery of the goods and services. Today, credit sales, credit sales. The credit sales are not, they are asking supply the stocks. The buyer asks the seller to supply the stocks. Once the goods are received, the buyer is not paid, then the loser will be the seller. So that's why the seller will ask the bank guarantee. For that also we will issue. Secures the advance payment made by the buyer to ensure the delivery of the goods or services. Whatever the services or goods, for that also the banks are issuing the bank guarantees. A supplier receives a 10% advance from a client, backed by bank guarantee ensuring return if undelivered. Some suppliers, they are asking advance amount. Once you have given 30% advance, then only I will supply. Otherwise, I don't want to supply. But the buyer also requires, once you have not supplied, that 30% who will pay? For that bank guarantee is required. Then I will pay the amount to you. So bank guarantees is the order of the day for every business organization. So that's why on account of that particular demand only, almost all banks, they have created manufacturing hubs for issuing the bank guarantees. They delinked from the branches. Why? Because if at all it is there in the branches, they may follow certain guidelines, they may not follow, they may charge a commission properly, they may not take the commission, all these things. So that's why lot of demand is there. That's why for country India, the hub of the trade finance center is located at Hyderabad. Like that, IDBI, north, east, west, south, the central processing centers are there. That much demand is there from the corporates for the bank guarantees. Issues the project owner that a bidder will take the contract if selected, prevents a withdrawal of the bidder. Whenever auctions are there, for that also they will ask. Once auction is over, 25% paid or 10% paid, remaining 90% not paid. Again, from the scratch onwards, the process will start. So some people in the auction, they will participate and they will pay the nominal amount and the final amount they have not paid. Again, it is a problem. In the meantime, whatever the assets are auctioned, it may be the perishable goods or safety, security, all these things are to be provided. Then that's why in a bidding process also, the bank guarantees are in the system. Bank guarantees are everywhere. A construction firm provides a bid bond while applying 5 crores government infrastructure projects, particularly national highway authorities or big highways. Whatever the contractors are there, the civil contracts, the flooded like anything, the bank guarantees. So a construction firm provides a bid bond while applying 5 crores government infrastructure project. For that also, in bid bond, whenever I am participating in the bid, I have to give the guarantee. Then only my name will be included in participation. Otherwise, they don't allow. If these riders are there, then the repetition process will be controlled. Deferred payment guarantee. The capital expenditure, machinery, proclines, bulldozers, cement companies, big plant and machinery is required. Banks are not giving the loan. The supply of manufacturers, they will give the loan. And that loan, they will fix an equated monthly installment. So here the banks are not giving, and the company is not having that much capex. In that scenario, some of the suppliers, they have started this finance companies, and they will supply directly the machinery to the company, and they will fix the span of 10 years or 15 years or 5 years or 20 years, whatever the and quarterly or monthly or half yearly or yearly installment they fix. But whether the buyer, whether he will pay the EMIs or not, that is a doubt to the supplier. That too, the machinery value is 1000 crores or 500 crores or 100 crores. Planted machinery, particularly in the cement company, cement manufacturing companies. Then the supplier of the machine, he will ask, you please bring the bank guarantee. As and when installment is due, if the buyer is paid, there is no obligation on the part of the bank. Otherwise, the bank has to pay that is installment. So this is a total tenure of the loan. If the guarantee, the total EMIs are spread into 15 years, 15 years guarantee is required. So that's why DPG, deferred payment guarantees. Used for import or equipment purchases where payments are made in installment over a period of time. The DPGs are within country, outside the country. If at all I am imported the goods from China and the machinery, particularly the cement companies, we are importing the plant and machinery from China. Banks are not giving that much fund because their capital is not sufficient to provide big loans, even infrastructure companies also. But banks are giving the DPG guarantees only for that installments. Once, as long as the borrower is paying installment, there is no obligation on the part of the bank. If the 15 years installment on quarterly basis means 60 installments paid, then there is no problem to the bank. And if one installment is not paid, immediately on the next same day, the supplier will inform to the bank, you have issued the DPG guarantee. The borrower is not paid. Please pay the installment. This installment is. If at all next installment not paid, again next installment the bank. Next installment. As long as the borrower is paid the installment or the applicant is paid the installment, there is no liability on the part of the bank. An importer buys a machine on credit and bank guarantee payment to the overseas supplier. So, as an IRP or RP, whenever you are handling the CIRP process or liquidation process, then you have to verify not only the loans and advances, contingent liabilities also. Normally, as per accounting system, contingent liabilities are mentioned in the footnote of the balance sheet. So if at all I'm the IRP or RP, first I will check up with the CFO. How many guarantees are taken by the company? And can I have the guarantee agreements if at all it is taken printouts? And whether it is matching with the footnote of the balance sheet or not. And some of the guarantees may be expired after a period. Suppose there is no claims, 1 year, 30 days or 60 days or 6 months or 9 months or 1 year, up to 10 years, banks are giving guarantees. In certain cases, even 15, 25 years also they can give, subject to the bank's board approval. So as an IRP, normally they are giving much attention or focus on assets and liabilities. Okay. But bank guarantees are not reflected in the balance sheet. It is a footnote of the balance sheet. And for that, the bank guarantees register also open. The date of issue, the expiry date, what security the bank, the company has given to the bank, how much cash margin. Cash margin means not simply the cash, how much a fixed deposit given. Any counter guarantee? I will discuss about the counter guarantee later on also. So the importer buys the machinery on credit and bank guarantees payment to the overseas supplier. Issued in lieu of money retained by the client as a performance security after the project completion. Particularly highway authorities, national highway authorities, or airport authority, or port authorities. In India, n number of infrastructure companies are there. Whenever they are giving the prominent infrastructure companies, they will ask the money issued in lieu of money retained client performance security for project completion. For that also, banks are issuing bank guarantees. Retention money guarantee. A contract requests to release the retained funds by providing bank guarantee for the same amount. So here, various types are there, various purposes are there, but in India, the bank guarantees are governed under Indian Contract Act. In India, all bank guarantees are governed under Indian Contract Act. That's why even early exam also, one question on bank guarantees also. But if at all guarantees crossed the boundaries of the country, then it is called letter of credit. Once it is crossed the boundaries of the country, then it is called letter of credit. Only 1 minute. Sir. Then it is called a letter of credit. But a letter of credit is governed under UCP DC 600 brochure, Uniform Customs and Practices for Documentary Credit. 600 brochure, that is the latest version of that letter of credit. So normally Letter of credit within the country also we will issue, or outside the country. Within country means governed by Contract Act. Other countries means that is UCPDC 600 brochure. Later on, I will request Madam also to discuss about letter of credits. What are the FEMA guidelines that are adopted by the bank? What is meant by UCPDC? What is meant by revolving letter of credit? What is meant by back-to-back letter of credit? So many types are there. We will ask Madam and I will discuss that also in one case. Okay, retention of money guarantee. A contractor requests to release the retained funds by providing bank guarantees of the same amount. Customs and excise guarantee. The company has to pay the customs duty and release the goods, or whatever the penalties imposed by the customs authority. The company is instantly, the funds are not there. Then they will go to the bank and they will get the bank guarantee and give it to them and take the goods and process for manufacturing. So sometimes the customs authorities also, whatever the penalties, whatever the demurrages on hourly basis. Once the ship is arrived, immediately within 24 hours or less than 24 hours, the beneficiary has to take back the goods. Otherwise, if they put in the port, in the godowns, then how much volume, length, breadth, and space, all these things they will recover on hourly basis. So ensure compliance with the customs or tax liabilities while deferring the duty of payments. Sometimes unnecessary. They are imposing some penalties. These penalties are to be paid. For that also bank guarantees are there. Once the customs authority told, okay, if at all the amount is not there, you bring the bank guarantee and take back the goods for demurrages or additional custom duties or penalties, etc., etc. A trader provides customs guarantee to clear the imported goods before paying applicable duties. So that's why even the customs authority will also accept the bank guarantees. Shipping guarantee. Issued shipping companies to release the goods before arrival of the original documents. The exporter send the goods from China to India through Visakhapatnam port or whatever the Calcutta port or Bombay port. But the documents are not came. The document will take another 3 to 5 days. In the meantime, if at all I retain the goods, demurrages on hourly basis, lakhs of rupees I have to pay the demurrages. Then the importer, he will take the bank guarantee, total goods value from the bank, and I will submit the document on arrival. In the meantime, please release the goods to avert that damages. So issued to the shipping companies to release the goods before arrival of the original documents. All these things are happening in almost all companies. Those who are involved in exports or imports or construction activities, or big cement companies, or big iron and steel companies, or big pharma companies. That's why we are always thinking about the live loans, that is the loans and advances. This is also one of the bank's business. We are, whatever the branches are there, bank guarantee is also big business for us. At least 50% or 40% of the loans and advances. Issued to the shipping companies to release the goods before arrival of the original documents. an importer uses shipping guarantee to take the goods when the bill of lading is delayed. Bill of lading, particularly the shipping authority, they will issue the goods are carried by the ships. Once the particular the shipping authorities, they will give the bill of lading. Once the bill of lading is submitted, then only goods will be released, like RR, railway receipt, RLR, lorry receipt, or in airports air cargos, the airway bill of lading, AWBL. So this once it is delayed, that is also there. Example of a bank guarantee. One example I am quoting here. Let us say XYZ, a newly launched textile company, wants to purchase raw fabric worth of 1 crore. The supplier, to safeguard the payment risk, asks XYZ Limited to provide a bank guarantee before dispatching the goods. Okay, I will provide goods, no doubt. Once goods are received by you, if not paid, to whom I have to ask? XYZ approaches its banks and obtain the guarantee. The bank essentially assures the suppliers that if XYZ is failed to make the payment, the bank will cover the loss to the supplier. This enables the supplier to confidently proceed with the order. Today, banks are also involved in the business process of whether it is a manufacturing or the contract, whatever the types are there. Loans and advances, that's why banks are called backbone to the economy. They are providing agriculture sector, industrial sector, service sector, the three important sector, and particularly the balance sheet size is there for loans and advances. Whatever the deposit capital is there, they will use. In addition to that, this service also bank guarantee. In other case, a leading furniture manufacturer plans to contract a small wood shop vendor 50 lakhs worth of material. The manufacturer requires a bank guarantee from the vendor to ensure timely complete the delivery. Take for example BHEL, Bharat Heavy Electricals Limited, or Reddy Labs, or GMR. So the airports, they will give the subcontracts. Once the subcontracts are there, all subcontractors, they have to issue from that parent, the main company to subcontractors, or main company will ask guarantees from the subcontractor. Even BHEL in Hyderabad, surrounding ancillary units, MSME ancillary companies are there. They are supplying so many items to the Bharat Heavy Electricals Limited, like ECL, Electronic Corporation of India. These companies, they will approach the bank. That's why banks are also put their captive branches inside that particular, the big public sector undertakings. So this is a routine activity. So what I am telling is, in IBC, particularly not only the financial creditor given the loan, but this is also to be factorized in the last, in the CIRP process, how the bank guarantees are to be addressed by the IRP or RP. That also I will discuss in detail. Here is the manufacturer is the beneficiary. If the wood shop fails to deliver the agreed, the manufacturer can claim compensation directly from the bank under the bank guarantees. Now bank guarantee sample. But here, the guarantee specimen is designed by the beneficiary. And the beneficiary, once the beneficiary is given that one to the applicant who is required the bank guarantee, the applicant will approach the bank. Sir, my the exporter is asking this type of guarantee. Then the banks will refer that one to law department, whether bank can issue that particular guarantee on the basis of terms and condition fixed by the particular beneficiary. Then based on the legal opinion from the law department, then we used to take the stamped agreement. On the stamped agreement, these conditions mentioned and above 50,000 two signatures. Now it is an electronic form, and this is also double authentication is also required. So the bank guarantee sample. The bank guarantee specimen is a template that outlines the bank commitment to pay the specified amount if the account holder fails to fulfill the contractual obligation. So here, it is not a common one. It differs from bank to bank. It differs from company to company. Infrastructure projects, their nomenclature or the terminology is different when compared to pharma company, when compared to exports, when compared to other the customs, etc., etc. There is no standard this one, but whether it affects the bank or not, that is to be due diligence will be verified by the law department before that one. There is no standard, but standard is nothing but the beneficiary, the applicant address, beneficiary address, and the banker who is signed, and the body of the agreement differ from, but amount is the whatever the amount they stipulated, that is that finally whatever the wordings are there, as per wordings, if the account the guarantee is devolved, the bank will pay the amount, whatever the amount is specified in the guarantee. So a bank guarantee specification is a template that outlines the bank's commitment to pay the specified amount if the account holder fails to fulfill the contractual obligations. Contractual obligations. Key elements include bank's name, bank's address, beneficiary details, that is the third party, the guarantee amount, the period of validity of the bank guarantee, and a clear statement that payment will be made on demand without protest. Without protest. Sometimes I am issuing a guarantee on ONGC, Oil Natural Gas Commission, on behalf of or HPCL, Hindustan Petroleum Chemicals Limited, or Maruti dealers for supplying the car to the dealers. Everywhere guarantees are there. But whenever I'm giving GAIL, Gas Authority Limited, or ONGC, that is they are in Dehradun, ONGC. But I'm in Hyderabad. My client asked me, and I have sent. And once my client told us, sir, ONGC people, Dehradun, they are hard net, sir. They have not provided any the gas cylinders to me. The ONGC, some gas related drilling and other things are not happened, sir. They have not paid, sir. Don't pay the amount like that. He will give the letter. I don't bother about the letter. First, once it is letter is received from ONGC, immediately I will create a loan in the name of the applicant and pay the amount. Otherwise, in future, nobody will believe the bank guarantees. So without on demand, without protest. Once that is happened, banks are to be penalized by the Reserve Bank of India. In that case, why you are doing that business? As per the terms and conditions, why you have listened the applicant name? The beneficiary is clearly telling that the applicant is not performed that particular job. So without protest, the document is specified in the conditions under the guarantee can be invoked. The process for claims and the clause confirm the guarantee irrevocability until the expiry. Sometimes revocable, irrevocable. What is a irrevocable? Sometimes the applicant will come, sir, I asked bank guarantee in the name of ONGC. Now I have cancelled that project, sir. Please give me back the security given by me and fixed deposit, whatever the margin. We don't give. You please bring the one letter from ONGC that the project is cancelled and return that one. And they have to send the other modes also. And ONGC, the Dehradun branch, they have to confirm that letter is issued by the ONGC or not. Otherwise, if at all he is fabricated, then bank will face the problem of a fraudulent transaction. So the document is specified and the conditions under the guarantee can be invoked. The process for claims. The clause confirming the guarantee's irrevocability. Revocable, irrevocable. All guarantees are irrevocable unless until the beneficiary consent is there, then only the bank guarantee can be cancelled. Otherwise, no question. Until expiry date. Whatever the expiry date is. The specification of the bank guarantee. The bank letterhead earlier we used to give the bank letterhead only. And with the stamp. The bank guarantees are attracted as per Indian Stamp Act. Bank guarantees are attracted in the Stamp Act. The Stamp Act is not common across all the states. Even today, agriculture, whenever we are giving loans to the agriculture, some states no stamp duty because they are the agriculturists, they are unable to bear the stamp duty also. Some states, even agriculture stamp duty. Some states, the bank guarantees are fixed amount for 10 lakhs or 1 crore. This one, 10,000 and 100 crores, that is 10 lakhs, like that. Some states ad valorem stamp duty. What is meant by ad valorem? Based on the amount, the stamp duty is varied. That is also to be paid. Otherwise, the bank guarantee is invalid. The bank guarantees are also attracts Limitation Act. That is section 18 and 19 of the Limitation Act. That is acknowledgement of debt and part payment of debt. So the bank guarantees are also attracts stamp duty. Stamp duty is not it is not a central government stamp duty. Central government stamp duty is only certain products like life insurance policies, central government stamp duty. Next, bill of exchange, central government, promissory note, central government. Like that, some documents, central government and remaining are state. It is a revenue to the state government. Stamp duty is a revenue to the state government. The bank's letterhead, the date of issue, the guarantee number, the serial. So that's why in the bank also, they will maintain the register. Whenever they are giving, they'll bring some infrastructure companies are there. And we will we will provide one complete ledger, some infrastructure company. Why? Because some guarantees are expired, some guarantees are it is a continuous process in infrastructure companies. So the big companies, number of daily they are asking gang guarantees, that guarantee, this guarantee, this guarantee, that guarantee. But at the same time, in CIRP also, how many bank guarantees? And get it confirmed from the bank also. And please verify the footnote in the balance sheet also. How many bank guarantees are outstanding? How many bank guarantees are devolved? How many bank guarantees are expired? That information also you have to solicit that information from the CFO, Chief Financial Officer of the company, if at all that is a going concern company. And address the beneficiary. If at all ONGC or GAIL or ECL or BHL, whatever the name is there. Title of the beneficiary, the purchaser, and subject to bank guarantee number, amount, etc. Whereas name of the account holder or contractor, here and after referred as an applicant, that is my borrower who requested the bank guarantee is called applicant, has entered an agreement with you, particularly with you means the beneficiary. Briefly describe the agreement, supply of goods, performance services, etc. In the bank guarantee, a detailed information is required. And finally, it should not give any inconvenience or day-to-day functioning of the bank. Finally, he has to tell how much amount in case the applicant is defaulted. Whereas the terms of the agreement, the applicant is required to be provided bank guarantee for an amount of, in numbers and words, in your favor. Now, therefore, we, name and address of the bank, hereinafter referred as a bank, do hereby irrevocably, we are giving that, otherwise the beneficiary will not accept the bank guarantee. Unconditionally, otherwise the beneficiary will not accept. Later on, the applicant will come, sir, cancel that bank guarantee. If at all irrevocable and unconditionally means, then automatically the beneficiary will accept the bank guarantee. Whatever the bank guarantee, that's why the matter of the particular bank guarantee will be drafted by the beneficiary and give it to the applicant. Applicant will give the bank to, and we will send that one to my legal department. Whether can I issue the guarantee? Because guarantees are not the 1 lakh or 10 lakhs, crores of rupees. Crores of rupees are there. So the guarantee we shall pay to you on demand at any time. Any all monies payable to the applicant to the extent amount without a demur, reservation, protest, or reference to the applicant. We are giving assurance to the beneficiary without any demur, without any reservation, without any protest, without any reference to the. Once I received the bank guarantee, the development of the bank guarantee, invoked the bank guarantee by the beneficiary, I need not talk with the contract applicant also. But normally we will provide some information. And without or reference to the applicant. Without a reference to the applicant, I have to pay immediately on the same day. If at all it is received by me after closing of the bank hours next day, otherwise on the same day, I have to pay the amount to the beneficiary. Conditions for invoking guarantee. This guarantee shall remain expiry date. Whenever we are issuing the bank guarantee, the invocation to be happened before expiry date, on expiry date, including on expiry date. Including on expiry date. That to banking times. Otherwise, it is not comes under payment in due course. Payment in due course. So the guarantee shall remain force until expiry date. Suppose the bank timings are 10:30 to 5:30. 5:25 received, 5:30 received. I have to honor that one. After that, but sometimes the claim lodge is also we are mentioning after expiry 1 week, after expiry 3 days. If that type of conditions are there, that also I have to honor. That also I have to mention in the guarantee itself. Even after expiry also, the claim lodging period is 6 days or 1 month or 15 days. Then I will take the commission, including that claim period also. Some people told 3 months bank guarantee, that is on so and so. I will lodge the claim after the expiry of the particular claim, 15 days. I have to wait. Even though expiry date is over, the claim period is also there. I have to wait. I have to honor that one. If during that claim period also, if they invoked a claim under this guarantee must be received by the bank in writing on or before last date of the lodging of the claim. But if claim period is there, that also I have to take into consideration. Bank liabilities under the guarantee is restricted to maximum amount. They should not ask interest. They should not ask any other amount. My liability, that is a bank liability, restricted to the amount mentioned in the guarantee, not even extra 1 rupee also. Other conditions. The bank guarantee agrees that such demand made by you on the bank shall conclusive regard of the amount payable by the bank under this guarantee. Such demand and a conclusion regards the amount payable under the guarantee. This guarantee shall not be affected any change in the constitution of the bank or the applicant. Suppose once the bank guarantee is given, after that the bank is merged with other bank, we will pay. Earlier Dena Bank is there, Andhra Bank is there. Now it is merged in Union Bank of India, Andhra Bank. Once it is merged, the bank will not tell, should not tell. No, the earlier bank has issued. This guarantee shall not affected by any change in the constitution of the bank or the applicant. Once I have given the guarantee, the bank has to pay. Even the constitution of both bank as well as applicant is changed. This guarantee is a continuing guarantee and shall remain in force and effect until the expiry. As long as the expiry period is there, it will be continued up to. Some guarantees, revolving guarantees. They will give the period 1 year, and once one work is performance is over, next again the maximum amount, whatever the amount is mentioned, another project. Each and every project he need not take a separate guarantee. So the period 1 year, maximum 1 year, and the covenants or the conditions we will stipulate in the guarantee. Each and every time taking a guarantee is also difficult for them. Suppose one road contract is there, that is a 10 lakhs completed within 1 month. Again, he has to another road contract. Again, he has to approach the bank. So for that 1 year, he will take and n number of times. Once the old one is over, next one is started maximum upper limit. That is called revolving guarantees. Revocation. The guarantee cannot be revoked by the bank during the currency without your previous consent in writing. We don't listen the applicant. Once I have given, I have to stick on the words of the beneficiary. I don't revoke unless the revocation, when I will accept from you later, you cancel the particular this one means I will cancel. Till such time, I don't. Then bank signature. Normally, the Reserve Bank of India stipulations also, two people are to be signed in the bank guarantee to authorize a signature and the seal of the bank, all this. But why the physical is shifted to electronic? One is the convenience. Second one is to mitigate the frauds. Third one is the system is automatically give the alert before 2 days or 3 days or on the day of a maturity also. The system will give some alerts. Now, up to this point of time, any doubts are there, sir? Any clarifications are required, sir? Sir, anybody, sir?
No, sir, we are good to go, sir.
Others, sir? Madam? Any clarifications? Okay. The uses of, sir.
Everything is very well.
No doubts, sir?
No doubt, sir.
Okay, sir. Thank you very much. Now, uses of bank guarantee. What are the, it is useful, it actually, banks are also, they don't require funds. For giving a loan, funds are required either by way of capital or debentures or bonds. Banks are also issued bonds. That is a type 2 bonds in capital. And private placement funds are also there. And deposit, the core sources of funds, but bank guarantees not required. Last, the part is section is on during CIRP, sir. Because first, if at all you know the total system, CIRP is a cakewalk for you. The total system, even particularly working capital or whatever the hypothecation did or mortgage did, whatever the banking process, because most of the cases of the financial creditor is either NBFC or banks. So that's why the applicant, how has given that a particular service or support or product, that we should know first. Then how to handle that product during CIRP, that is second part. When large companies are purchased from small vendors, they generally require vendors to provide guarantee certificate from the banks before providing such business opportunity. When large companies are purchased from, they generally require vendors to provide guarantee certificate from banks before providing such business opportunity. Predominantly, purchase and sale of goods on credit basis, where the seller is issued payment from the banker in case of default by the buyer. That is the purpose of the guarantee. Bank is an intermediary between the buyer and the seller, or between the applicant and the beneficiary. Bank is an intermediary. Why the banks, they are believing it is a scheduled commercial bank. If at all I am giving guarantee, nobody will believe. But bank is a scheduled commercial bank. But Normally, small banks, cooperative banks, normally the beneficiary will not believe. Even foreign countries also, they will stipulate the bank name also. You take that guarantee from Punjab National Bank. You take the guarantee from State Bank of India. Please take the guarantee from Canara Bank. They will study the balance sheet, the size of the balance sheet, the reputation of the balance sheet, the Camel's rating, Camel's rate of the bank. Camels means capital, adequacy, asset quality, management, earnings, liquidity, and systems. Helps in certifying the credibility of the individuals, which in turn enables them in obtaining loans and also assist in business activity. Particularly, sir, in MSME clusters also, whenever they are purchasing the goods, raw materials, they are taking the guarantee from the bank and they are giving to the suppliers. Then only the goods will supply. Otherwise, no. Helps in supplying the credibility of the individuals, which in turn enables them in obtaining loans and also assist in business activities. Bank guarantees are widely used in business or trade to fulfill tender conditions, backup performance of the contracts, and hence can enhance the credibility during negotiations. All these things are happening. Bank guarantees are widely today. That's why whenever we are giving importance for the financial creditor, the claims of loans and advances, to that extent, you have to give the importance. Whenever the banks are sending their claim on guarantees also, you have to verify, means once you are having the knowledge about a bank guarantee, then claims verification during CIRP is also very, very, very easy. Very, very, very easy. Though there is a lot of uses from the bank guarantees for the applicant, the bank should process the same only after ensuring the financial stability of the applicant and process the same only after ensuring the financial stability. Even everybody, if at all they are asking bank guarantee, banks are not giving the bank guarantee. Even though it is a contract, banks, they don't give the financial stability. Whether he will fulfill, even performance guarantees also banks are not giving guarantee. Performance guarantees are to be converted into financial. In that sense also, how long this person is there, how many performances he is not honored, the background verification, particularly Dun and Bradstreet, we will take the opinion from the D and B. D and B. One is international reputed agency, investigation agency about all the financial, even 29A under IBC also, we can take the assistance of D and B for verification of the prospective resolution of whether he is disqualified under 29A or not. For that also, we will take D and B, Dun and Bradstreet. Dun and Bradstreet. The risk involved providing such a guarantee must be analyzed thoroughly by the bank. Only in case of 100% cash margin, banks are some leverage will be there. Otherwise, if at all he is offered collateral security, like land or building. Today, even though banks are taking collateral security for loans and advances, most of them are failed. That's why some of the cases are filed with the NCLT. But this is a high risk when compared to loans and advances. In the loans and advances, some primary security is there. Here, there is no primary security. All are collateral security only. Once I am giving stock, stock is the primary security. For that stock, if at all he offered a land and building, that is a collateral security. In case of guarantee, I am having only collateral, no primary. That's why the riskiness is more in the bank guarantees. Advantages and disadvantages of bank guarantees. The bank guarantees reduce the financial risk involved in the business transaction, particularly for the companies. They need not provide the funds to the beneficiaries. Simply take the bank guarantee for suppliers, for the government in case of contracts, road contracts or whatever the infrastructure contracts. Due to low risk, it encourages the seller or a beneficiary to expand their business and a credit basis. So on account of bank guarantees only, lot of credits are happening. Instant amount is not provided by the companies. Bank guarantees are generally low fees guarantee. Once the loan is taken, whether the borrower is wake up or sleeping, the interest will be calculated by the core banking system, the software. Day by day interest is calculated. But in case of a bank guarantees, no question of interest, only one-time fees, that is called commission. That commission is depending on the period amount. Normally, that is very, very low when compared to the loans, which beneficial even small-scale business also. When banks analyze the certify the financial stability of the business, its credibility increases, and this in turn increases the business opportunities. Once the banks are giving the bank guarantees to the applicants image will also increase. Why? Because this applicant got bank guarantee means bank identified this person is having credit worthiness. That's why he will get some loan opportunities in the market also, directly or indirectly. Mostly, the bank guarantees require fewer documents. But in case of loans, hypothecation agreement, mortgage agreement, terms and condition, appraisal, financial statements, or unit visit, site visit, so many things are there. But in bank guarantees, quick disposal. Most bank guarantees require fewer documents, and whatever the bank guarantee is there, whatever the basic information followed by one page of the appraisal. That's all, nothing else. By the banks, if documents are submitted. On the flip side, that is the disadvantages. There are some disadvantages are also there in the bank guarantees. What are the disadvantages? Sometimes banks are so rigid in assessing the financial. If at all he is a new person, normally we don't give. If you give 100% margin, then only I will give this one. And this makes process complicated, time consuming. For new promoters and startups, normally we don't give. They will lose this facility. With a strict assessment of banks, it is very difficult to obtain bank guarantee by loss-making entities. In some parts of the country, bank guarantees are also misutilized. Some unscrupulous persons, they are preparing the bank guarantees like a bank guarantee specimen, signature, and they will trace the officer's signature, and they will sell to the contractors. If contractor approaches the bank, he has to pay the processing charges, he has to pay the stamp duty, he has to pay the commission to the bank, and he has to give the assets of the company, he has to pay fixed deposit in case bank asks. All these things are there. But some, like forged notes, people, this type of unscrupulous, that's why banks are now digitalized bank guarantees. That rocket is there in some parts of the country. That's why from time to time, Reserve Bank of India give alerts to the banks. Be careful while issuing the bank guarantees. Big rocket is going on. They are preparing the bank guarantees and they are selling the bank guarantees. Even if all the particular assets are required and a commission processing, they will sell the bank guarantees for 10 lakhs. You give 1,000 or 2,000. Like that they are selling. And that beneficiary sometimes he is not able to verify also, because the beneficiary is also businessman. He is having multiple activities. That's why whatever the guarantee, like some forged, some unscrupulous persons, if at all they are giving forged notes, then some unknown people, they are facing the problem. In the similar type, sometimes banks are so rigid in assessing the financial position of the business. This makes the process complicated and time consuming. With the strict assessment of banks, it is very difficult to obtain the bank guarantee by loss-making entities. If at all the company is incurring loss for the few years, banks, they don't give any bank guarantees. Because of the financial health position of the company is also should be good. Then only the bank will give the bank guarantees. Otherwise, they don't give. For certain guarantees involving high value, high transaction, banks will require collateral security to process, particularly Adani or Reliance or GMR or GVK or Vijay Electricals or Reddy Labs or big companies, the infrastructure companies. They don't insist 100% collateral security. A small amount. It depends upon the credit policy guidelines of the bank. Even if the company is a going concern, that too infrastructure company, you have to handle the bank guarantees also, being a IRP. Because you are the CEO of the different company. And if the company is a going concern, the company has to be continued. And if at all it is an infrastructure company, and you should, thorough knowledge is required, what type of a bank guarantee, because each and every guarantee, if at all required, you have to take from the bank, and once the guarantee is given, then only the stocks or services the beneficiary will provide to you. For certain guarantee involving high value, high risk transaction, bank require collateral security also to process the guarantee. Bank guarantees, the eligibility and process. What is the eligibility? After this, we will break for teaser. Bank guarantees, eligibility and process. Any person who has a good financial record is eligible for apply the bank guarantee. Now, in CIRP, our company is not a good financial record. But in this case, if at all new guarantees are required, but a COC is there, the financial criteria is with you only. Based on the needs, he will prepare the note and get it approved from their banks. Even interim finance also, particularly the health position of the company is not good. To get interim finance is also difficult. But whatever the interim finance is there, it is covered under CIRP process. Process cost, say the IRP costs. Then today, some of the financial institutions, they are ready to give, because the rate of interest is also a little bit higher. Bank guarantees can be applied the business in his or bank or any other offering such services. Normally, the bank guarantees who the company with some XYZ bank or ABC bank, they will issue, and in certain cases, they will approach the other banks also. Before approving the bank guarantee, bank will analyze the previous banking history, credit worthiness, liquidity of the company, CRISIL rating, and CIBIL rating of the applicant. These are also very much required. Before approving the bank guarantee, they will analyze the previous banking history. Because once he is having working capital, how this one? But we are talking about CIRP, which the previous banking history is not up to the mark. It is a defaulted company. Defaulted means whether it is a willful defaulter or intentionally or any wrong, then here also the financial creditor is there. Daily the IRP or RP, they are interacting with the financial creditors. They have to come into the rescue. Credit worthiness. But here, unencumbered securities are there. Some unencumbered securities. So whatever the total claims are there, not exceeding 10%, you go. But here also, once the financial creditor is there, NCLT told, IBBA told that the company should be continued as a going concern. That is a preamble of the IBC. Once it is going concern, then the value maximization will happen. Otherwise, the value maximization will not happen. Being a IRP or RP, you have to convince your COC. And today, some of the financial institutions, they are ready to provide interim finance with a higher rate of interest. Even though they know pretty well about this company is a defunct company and a bad company, the promoters on account of the various reasons or mismanagement, the company facing the problem of the IBC or CIRP process like that. But here, the liquidity, the CRISIL rating. Okay, this is the loan failed. Earlier, all are good. Or the potentiality is there in the company. Future prospects is there, and definitely resolution persons will acquire this company, prospective resolution applicant. And whenever the bank guarantees are issued, the company rating, that is a CRISIL or ICRA, they will give every year. Some companies, they will get the rating, whether that rating is available with the company or not. That is a ICRA or CRISIL like that. And CIBIL rating, normally CIBIL or a CRIF high mark, that whatever the loans available, them, how the repayment, all these things they are mentioning. The bank will also examine the BG period, value, beneficiary details, and currency as required for approval. Some other country bank guarantees are required. Then currency, the tenure, all these things they will. In certain cases, banks will require security to be provided by the applicant to cover the bank guarantees. Bank guarantees whenever they are giving. So that's why. Suppose you take for example, XYZ CIRP you are handling. In that particular company, one bank guarantee taken by the company that is expired before commencement of CIRP. But the corporate debtor is not taken back the cash margin, that is 25% of the bank guarantee, and the collateral security offered. Being a IRP or RP, this is not reflected anywhere. But here, that's why you have to verify the bank guarantees register of the company also. Then once it is expired, whether the company taken back the security offered, security documents or not, that is also useful. or the cash margin fixed, but all these things are available in the balance sheet assets, whether it is a fixed deposit or any more immobile property, etc. Once the bank officials are satisfied with the criteria, they will provide necessary approval for they required for processing the BG. They will give the approval. Now we will take a break for tea break, sir. 10 minutes.
Sir, I have some questions.
Tell me, sir. Tell me, sir.
No, sir. No, sir. Actually, I would like to ask you about what is the difference between the bank guarantee and the letter of credit?
That also it is there, sir, in this slide. In this slide, after tea
Okay.
break, the difference
Yeah.
between bank guarantee and LOC is also there. That also I will discuss, sir.
No
Is it
issues. We'll
okay, sir?
discuss. Yeah. Discuss after some after tea break, sir.
Yes, sir. Definitely. 100%.
Tea break, how much time the tea break is there? 10 minutes.
No, only 10 minutes, sir. Now it is 4:08, sir.
Okay.
4:18 we will meet. 4:18.
All right, Ji. Thank you.
Okay, sir. Okay, sir. Now, the bank charges. The banks are also charging two types of charges for a bank guarantee. Why I have given this much discussion is, if at all it is a going concern, the company has to take bank guarantees. And once I have discussed it in detail, the prospective resolution applicants also, they have to give the guarantees. So guarantee is importance is there in CIRP process. That's why I'm giving in detail discussion about the bank guarantees. Anyhow, once this is over, then during CIRP, how the bank guarantees are to be handled, that also I will discuss, liquidation or this one. The bank charges. Generally, bank guarantees are charged based on the risk assumed by the bank in each transaction. For example, financial bank guarantees are costly when compared to the performance guarantees. In most of the performance, even though the performance is converted into financial, still the risk rate is less. That's why the financial BGs are high risk when compared to the performance guarantees. The fees for financial bank guarantees will be higher than the fee charged by the performance bank guarantees. Based on the type of the bank guarantees, fees is generally charged on a quarterly basis on the BG value and 0.75% or 0.50% during the BG validity period. The validity period is starting date of the BG, expiry date. If a claim period is also there, that is also to be added. Apart from this, banks may also charge application processing fees to process the bank guarantee. First, we have to take the application and we have to verify the credentials of the financial creditor, the corporate data, and whether he is adhered or not earlier this one, and whatever the documentation fee, stamp duty, and handling fees, all these things we will recover. And in some cases, security is required. The applicant generally 100% of the BG value. If at all 100 crores are required, 100 crores worth of collateral and small portion, some banks at 10%, some banks at 25% of the bank guarantee value as cash margin. Cash means not simply cash, either fixed deposit or any other deposits of the company. They have to give as a lien. And in certain cases, collateral security or cash margin may also be accepted issuing bank. If at all he is a new customer to the bank, new company to the bank, we will insist the 100% cash margin. 100% cash margin means 100% fixed deposit. And as in some cases, 75% the land or buildings value and 25% is a fixed deposit. But like a Tata or a Reliance, or depending upon the reputation and creditworthiness of the companies, banks are taking only 50%, in certain cases 40% also. So security will differ from person to person. Difference between bank guarantee and a letter of credit. One professional also, they asked about the difference between, what is the difference between a bank guarantee and a letter of credit? LOC is a financial document which imposes an obligation on the bank to make the payment to the beneficiary on completion of certain required by the applicant. Here, suppose I take for example, goods are supplied. And once a supplied intimation is given to the bank will pay the amount. That is called a letter of credit. And in case of bank guarantee, suppose a contract not completed on due date, then whatever the loss incurred by the beneficiary that is to be compensated, that is bank guarantee. Letter of credit issued by the bank when the buyer requests his bank to make the payment to the seller on receipt of certain goods or services, whether supply of goods or services. That is when the buyer runs into cash flows, difficulties or similar situation that cannot be immediate payment to the seller, he will approach the bank to make the payment to the seller on submission of certain documents. That is the letter of credit. The bank will later recover the amount paid to the buyer from the buyer along with the required charges. Once the bank is paid the amount, from the date of payment, the bank will charge interest on that particular funds and other incidental charges, if any. On the other hand, bank guarantee is required to make the payment to the particular third party only if the applicant fails to make the payment to the third party, does not fulfill the required obligation under the contract. So at the time of starting, I told about the contractor. The contractor not completed, he failed that particular agreement 2 years. Then whatever the loss is there, that loss is to be paid by the banker. So that is the bank guarantee. A bank guarantee essentially used to ensure seller from loss or damage due to non-performance by the other party in the contract. The seller from loss or damage due to non-performance by other party in the contract. LOC is generally misunderstood as bank guarantee, since there are some common characteristics also. And they both play a significant role in trading finance when the parties in the transaction does not have established the business relation. However, there is a lot of difference between LOC and bank guarantee. What are the difference? Broad. The major difference between a letter of credit and bank guarantees are nature. LOC is an obligation to pay accepted by the bank to make the payment to the beneficiary certain services performed. Once the services are over, he will pay. Later on, he will recover from the applicant. Bank guarantee is an assurance given by the bank to the beneficiary to make the specified payment in case of default by the applicant. Default. Once I received the goods, sir, please pay the amount. Later on, I will pay the amount. That is almost a letter of credit. But here, this is a different primary liability. Bank retains a primary liability to make the payment and later collects from the customer. But whereas in bank guarantees, bank assumes to make the payment only when the customer defaults make the payment. And payment. Bank makes the payment to the beneficiary as and when due. It need not wait for a default to be made by the customer. Only when the customer defaults the payment to the beneficiary, the bank makes the payment. That is the difference between the bank guarantee and the letter of credit. Way of working. Letter of credit ensures the amount will be paid as long as the services are performed as per the agreed terms. It is a continuous one. Bank guarantee assures to compensate for the loss if the applicant does not satisfy the specific conditions. So that's why there is a difference between both are not equal. Both are not equal. Difference is there. Number of parties involved. If you see the letter of credit, multiple parties involved. Issuing bank, its customer, the beneficiary third party, and the advising bank is also there. Another bank is there. But in case of a bank guarantee, only 3. That is the banker, its customer, the applicant, and the beneficiary, third party. Suitability. Generally, there is a more appropriate during the import and export of goods and services. That's why letter of credits we are widely using. Even domestic auto LOC we will use, but normally letter of credit we will use mostly in exports and imports from one country to another country. That's why I told initially also, not a domestic LCs, export and import LCs are governed by uniform customs and trade practice of the uniform customs and practice for document credit. That is UCPDC 600 brochure. That is developed by International Chamber of Commerce, Paris. That we will governed particularly LOC for export and import. Domestic Indian Contract Act. Shoots are any business personal transaction, particularly bank guarantees. Risk. Bank assumes more risk than the customer. Customer assumes the primary risk. The primary risk in bank guarantees, the customer assumes the primary risk. Whether he will do or not, that is a question mark for me. But a bank assumes more risk. Once the goods are received, then bank, as per the LOC, we have to pay the amount. A bank guarantee is a critical financial tool that supports trust in the commercial transaction. Today, it is an important one. That's why, even though we are talking about the particularly the loans and other things, bank guarantees is also part of the functioning of any company. But it is a contingent liability. Some of the guarantees are invoked means later on that guarantees are to be they paid by the RP during CIRP processes. When the buyer or seller or the service provider understanding what is a bank guarantee helps reduce the financial risk and secures the business deals. Whether it is a buyer or seller or service provider, understanding what is the bank guarantee helps to reduce the financial and secured. That's why you are going to act as an IRP or RP or liquidator. 100%. Most of the companies, they are using the bank guarantees widely on par with the fund. That's why some of the companies, they are using the bank guarantee, 50% bank guarantee, 50% loan. Bank guarantees limits are also there. The limits, some companies bank guarantee up to 50 lakhs, 50 crores. So up to 50 crores, whatever it is there, they will use that particular 50 crores, that bank guarantee they will use. So that's why it is a part of the corporate finance. So that's why you have to study this. You have to understand this one, because in CIRP, this type of situations will come. Hence, bank guarantee means a bank guarantee is a financial assurance issued by the bank on behalf of its customer to assure a benefit third party that the bank will fulfill the customer liability if they committed a default. And to conclude all these things, so the difference between LC and BG is the bank guarantee assures a payment to a third party in case of a customer defaults payment, while the letter of credit is issued to make the payment to the seller upon completion of certain services. And the limit of a BG. The monetary limit, the duration of the bank guarantee is determined by the issuing bank based on borrower's creditworthiness, financial standing position of the borrower, nature of the guarantee, and the specific policy of the issuing bank All these things are to be taken into consideration while issuing the bank guarantees. The eligibility for bank guarantee is any person who is a good financial record is eligible to apply for bank guarantee. No doubt at all. So the bank guarantee is a valid. Generally, bank guarantees are issued for short term. However, it should not normally exceed 10 years. 10 years normally exceed. But if at all some companies project finance, big projects are there, definitely bank guarantees are more than 10 years. But banks board also, they will give the permission, and whether it is a 10 years or 5 years or 1 year or whatever the period is there, that is defined in credit policy guidelines of the bank. Credit policy guidelines of the bank. While a bank guarantee is the form of a contract of guarantee defined under Section 126 of Indian Contract Act 1872. If at all any disputes are arise between the banker and the applicant or the beneficiary, if they have filed in court, that is under Section 126 Indian Contract Act clearly defines the bank guarantees. It's a separate and independent contract between the bank guarantor and the beneficiary. Beneficiary and guarantor, because on behalf of that particular the applicant, we have issued the bank guarantee, and we have to pay to the beneficiary as and when he invoked, and without any protest, without any raising doubts, without any remarks, without contacting the applicant. So that's why 126 are clearly defined about the bank guarantees. This means bank's obligation to pay the beneficiary is not dependent on a dispute arising from the underlying contract between the beneficiary and the bank customer. So not dependent. They don't bother about the dispute between the beneficiary and the applicant. I'm separate. Once the beneficiary is asking about the devolvement, they invoked the guarantee, I have to pay. I need not ask what is the dispute. And if that is the case, there is no sanctity to issue. Then nobody will believe that bank guarantees are not to be, the bank guarantees are a good one like that. So bank guarantees today, everybody is accepting. Once the problem invoked, immediately, without second thought, without contacting the applicant, the bank guarantees will be paid by the banks. That's why the importance is there. That's why every company, whether they are believing the buyer or not, they will believe the banker only. So if the buyer creativeness all are poor, no problem. Once the bank is ready to give the guarantee, I will issue the bank guarantees. Additional information, bank guarantees. The parties involved, three parties. One is the applicant, he is the principal debtor. The person whose behalf of the guarantee is issued. The beneficiary creditor, the person whose favor the guarantee is issued, that is the creditor. And the banker, particularly guarantee or surety given by the banker, the bank who provides the guarantee. These are the three parties that are there in the bank guarantee. The principles of autonomy. Bank guarantees operate principles of autonomy, meaning independent of the main contract between the applicant and the beneficiary. I'm not bothered about their contracts. I have given this one. Once in my devolved, immediately I have to pay. I am Autonomy, principles of autonomy. I am independent. I am not depending on the borrower's contention or beneficiary's contention. Once the beneficiary is sent back the bank guarantee, so my client is not honored, not provided, not completed the service without asking why he is not completed, what you have asked, what he has done, and whether that the condition is there in the agreement. No, we don't. That's why it is independent, and it is the principles of autonomy. The bank must honor its undertaking when guarantee is invoked, provided invocation is legitimate and no court or prevent it. Whenever I am the invoked, if at all I received a court order, in that case, I have to stop. Only I will listen the honorable courts. So the client, the beneficiary is invoked. The borrower, the applicant is telling, don't pay, sir, don't pay, sir, like that. I don't listen the borrower word. In the meantime, if at all I received a court order, then I will look into judicial intervention. Courts are generally do not interfere with the invocation of the bank guarantees. That also there. That's why once the court is given order, some reason is there, some purpose is there. So except a specific and a limited circumstance. If at all it is a fraudulent transaction, either from the beneficiary or the applicant, then these are typically included. Then fraud, egregious, where there is a clear evidence of the fraud on the part of the beneficiary that would vitiate the entire transaction. Then only I will listen. Irretrievable injustice. When the exceptional case, harm or injustice would be caused allowing the bank guarantee to be encashed. In that case, I will listen. Judicial intervention only I will listen. Otherwise, the banks will not. So once you understand all these concepts while handling bank guarantee during CIRP, a smooth sailing process will happen. The Reserve Bank of India also governs inland bank guarantees. That is BGs. Recently, that is 1st April 2025, they have issued the master circular also. If at all in extreme cases, any clarifications are required, go through that one. Key norms exercising caution of the performance guarantees, restricting maturity up to 10 years and obtaining sufficiently security margin, etc. Include exercise caution in performance guarantee. Reserve Bank of India told, whenever you are giving performance guarantees, you must be cautious one. Restricting maturity typically to 10 years and obtaining sufficient security or margin. Whenever the banks are giving security, you take margin, cash margin you take, then only you give the guarantee. Not even though it is simply a paper or document or stamped paper, because your signature play a vital role. It is a money. It is a money. Like even currency notes also. I promise to pay a sum of rupees. The governor of Reserve Bank of India also given guarantee to the public who is handling that currency note, whether it is a 500 or 200 or 100 or 50 or 20 or 10 or 5 or 2 rupees like that. The key guidelines of issuing bank guarantee. Guarantee type and purpose. Bank should primarily focus on providing financial guarantee and use a discretion for performance guarantee. So once the performance is converted into financial, then only they will consider. Otherwise, normally the performance guarantees the banks will not give. Guarantee should not enable funds placement with the non-banking financial companies or other non-banking entities including interbank loans, etc. For this, banks should not use or should not give any guarantees for this purpose. Maturity. Today, the maturity is also, previously it is restricted to 10 years. Now the Reserve Bank of India also relaxed that one. Even banks can now issue guarantee for longer period to align with the long-term project finance. Big projects are there. And for that projects, 10 years, more than 10 years guarantee is required. And manage the assets and liabilities, impact on the board approved policy, etc. Next, security and margin. Banks must undertake a diligent appraisal process similar to fund-based facility to ensure customer financial capability. To repay if the guarantee is invoked. Security and margin. Banks must undertake a diligent appraisal process similar to fund-based. So whenever the banks are giving loans, what are the precautions they will take? The similar precautions they should take for the others also. Customer financial capacity to repay them. They must obtain adequate security. Whenever they are giving bank guarantees, they have to take adequate security, which can be cash margin or tangible collaterals. So that's why in most of the banks, the cash margin is nothing but a fixed deposit and a collateral security also. Unsecured guarantee should be avoided for large amounts and a longer duration. That is the Reserve Bank of India guidelines. No question of unsecured guarantees should be avoided for larger amount and a longer duration. Customer relationship. Bank should generally refrain from issuing guarantees from non-customer who do not enjoy the credit facility unless thorough scrutiny in the finance. That's why I told earlier also. Whenever the new customers are approaching, banks will insist for 100% cash margin. Internal controls to mitigate bank guarantees are serially numbered securities. And today, the fraudulent bank guarantees are like currency notes, fraudulent currency notes, like bank guarantees are also there. Implement joint signature on the specified threshold limit. Once it is 50,000 above, the two officers are to be signed on the bank guarantees with the name, employee number, etc. Inform beneficiary to verify the bank guarantee's authenticity with the issuing bank. Inform beneficiary to verify once the beneficiary receives the bank guarantee, he has to, particularly this is a big fraud, a lot of frauds are happening in the jewelry exporters or jewelries. They are taking the bank guarantees or letter of credits, and the number of cases fraudulent or cheating the bank is also there. So that's why the Reserve Bank of India from time to time they are issuing the guidance to the bank, guarantees authenticity and issuing the bank. Insolvency risk. When the issuing guarantees for the corporate subsidiaries with an unsatisfactory financial position, bank can obtain counter guarantee from the parent company. In addition to securities, counter guarantee is also to be taken. Whenever the subsidiary companies, they require any guarantee, and to avoid that insolvency and other things, guarantee from the parent companies will also be taken in addition to cash margin, in addition to the collateral security also. Like the personal guarantor to corporate data. Even though at the time of taking the loan, the financial creditor will ask the primary security, collateral security. And the banks will also ask the PG to CD, personal guarantor to corporate data, in the similar manner in the guarantees also. In case where the personal guarantees are deemed necessary for stressed unit, a covenant in the loan agreement can be used to ensure directors execute a personal guarantee if financial conditions are worsened. Even in the guarantees also, you can take. Once the guarantees are devolved and the amount is converted into contingent to loan, then if the amount is not recovered, even the particular banks can file under a personal guarantor to corporate for shortfall amount during CIR. Special circumstances, even stock and commodities also, the guarantees are will insist for brokers and a credit facility from other banks, financial insurer. The guarantees can be issued for loans from financial insurer, but guarantees bank must assume funded exposure at least 10% of the guaranteed amount. These are the other areas of the guarantee. Honoring invoked guarantee. Whenever the guarantee is invoked, RBI emphasizes banks must honor. They should not reject. Otherwise, the importance of guarantee will lost. Invoked guarantee promptly without dispute, except in case of frauds. If at all any fraudulent is there, then maintain credibility of the banking system. All these things are to be taken into consideration. A company must register with a charge of ROC. Whenever the companies, this is also one source to the IRP or RP. How many guarantees are issued? Whenever the bank are issued guarantees and offered by collateral securities by the companies, that is to be registered with the ROCs, the section 77 of the Companies Act. So that is also, if records are not available, you please verify the charges created under section 77 of the Companies Act. So a company must register charge with ROC for a bank guarantee obtained against the security of the company. This is because of a bank guarantee creates a charge or security interest on the company's property, which must be registered within 30 days of its creation to be legally valid. Legally valid. So within 30 days, that is to be registered. Duty of the registrar. Section 77, subsection 1 of the mandate, every company creating charge on the asset must register particulars of the charge of the ROC. This includes charges created both within outside India. What to register? The registration requires the details of charge, copy of the instrument, and bank guarantee, and signatures of both the company and the charge holder of the bank. If these are for every bank guarantee, banks are also used to create charge with the ROC also. Time limit. The charge must be registered within 30 days. Consequence of non-charge. Failure to register the charge can lead to penalties, and that may affect the bank security interest, and other creditors may not be aware of the charge. So that's why within 30 days, the charge is to be created. Banks are perfect in this area, particularly whenever they are lending, they will do this process. And if that bank guarantees information is not available with the corporate data or books are missing, the second source of where how many bank guarantees and which bank has given what security, all these things are available in ROC also. Corrective action. If a company fails to register, the bank can apply to ROC for registration after giving the company 14 days notice, prior notice. If a company fails to register, the bank can ROC. If the company is missing, then bank can send one letter, 14 days notice to the company and register with ROC. The bank can recover the registration fees from the company. Anyhow, the loans are with the company, loans of the company is with the bank, they will debit to the account. During the CIRP, now I am discussing about the CIRP. During corporate insolvency resolution process, the handling of the bank guarantees secured 100% cash margin. What is meant by 100% cash margin? Bank guarantee issue. The fixed deposit 100 is there. 100 crores, 100 crores deposit. Collateral provided by the corporate debtor. Governed by specific principles and established in judicial precedents under the IBC. Now I will discuss about in detail. Judicial precedents, particularly IBC established. Margin money provided by the bank guarantee is treated as a trust asset for the beneficiary, not an asset of the corporate debtor. Suppose one CIRP is handling by you, and that company has taken 50 crores bank guarantee. For 50 crores, 100% cash margin. 50 crores fixed deposit is. No, CIRP prevail over other acts. You give that 50 crores fixed deposit to us means no. That's why judicial precedents under IBC established that margin provided for bank guarantee is to be treated as trust asset for the beneficiary and not an asset of the corporate debtor asset. So during that bank guarantee period, as long as the bank guarantee is continuing, don't touch by the IRP or RP on that margin. That margin is the treated as a trust asset for the beneficiary, not an asset of the corporate. Once the bank guarantee is expired, the beneficiary is not made any claim, then the IRP or RP can take back that 50 crores fixed deposit, if any, with the bank. Are you getting my point or not, sir? Sir, here. Sir or madam? Am I audible, sir? Hello?
Yes, sir. Yes, sir.
Yes,
sir.
Yes, sir. Audible.
Okay. So judicial precedents that IBC established, margin money. I told about margin. What is a margin? Suppose 100 crores bank guarantee requested by the ABC company. 100 crores means the bank will take 75%, 75 crores, the land or building, 25 crores, the cash margin. Cash margin means the fixed deposit. The fixed deposit, the cash margin, if the margin, whatever the margin is there, that margin you should not take. Principles. This means margin money is excluded from the moratorium under section 14 of the IBC. Allowing the bank to appropriate if a BG is lawfully invoked. Once the beneficiary is invoked, then the margin to be appropriated. The margin is appropriated by the bank. Suppose 100 crores invoked. Immediately bank will create 100 crores loan. 25 crores fixed deposit they will cancel and credit. Remaining 75 crores. For this 75 crores, the land and buildings are there. Then loan amount to be claimed with IRP or RP, and whatever the property given, that also. And in case of liquidation, if at all the liquidator is relinquished that one, then only the liquidator will sell the property. Otherwise, the financial creditor can sell the property, and whatever the balance amount is, that amount to be given to the liquidator. The beneficiary can invoke the guarantee during CIRP. The bank is obligated to honor it. During CIRP, if at all the beneficiary, the bank guarantee I have given on behalf of the company, that is obligated. Once the appropriated, the margin money cannot be claimed back by the corporate debtor or the resolution professional. Once appropriated, that is 100 crores loan created, 25 crores credited, 75 margin money, and the resolution professional, that is you should not touch, the corporate debtor also should not touch the margin money. The processing steps in CIR. What are the various steps in CIR with regard to bank guarantees? Invoked BGs, first point 1. If a BG is invoked during CIRP, bank will use the margin money and pay the beneficiary. That is first step. Otherwise, in future, nobody will believe the banks. And bank guarantees, nobody will ask us. We have to honor. Bank has to honor that the Reserve Bank of India regulator also don't reject. No question of discussion. First it is invoked, pay that amount. Subject to genuine transaction, not a fraudulent transaction. The RP cannot prevent this appropriation due to moratorium. Cannot prevent this appropriation due to moratorium. Moratorium is there. You have to give all your assets, the fixed deposit, margin money also, you go back. We should not. The IRP or RP or the in case of liquidation, they should not ask. First, appropriate them. If margin was insufficient, the bank can file a claim for the balance amount under CA. Suppose margin is given, only 25, 75%, no security. Then the 75 crores claim is to be submitted. Don't think about it is not within the 90 days or once the public announcement is given, you have not claimed, you are not eligible, that type of, because when the guarantee invoked, nobody knows. IRP or RP, they should not discuss this one. Simply, whatever the claims are there, it is a financial creditor. And after invocation, he is also particularly participate in the COC voting rate according to the amount. All these things are there. The bank can file a claim for the balance amount in CIR. Invoked bank guarantees. For uninvoked, invocation is there, the beneficiary is invoked. Some guarantees during CIRP, nobody will invoke. In that case, for uninvoked bank guarantees, bank or beneficiary may file a contingent liability with the resolution, the resolution profession. The banks, boss, this is a contingent liability. Today, it is not claimed. So far, not claimed. When he will invoke, I don't know. I should not give any pressure to invoke. But this is a contingent liability. It becomes a liability in future. And once the expiry date is over, then it is not liability. This claim should be considered in the resolution process. The resolution plan may need to address these BJCs. So this, whatever the contingency claims are there, this resolution plan, the prospective, whenever you are preparing that information memoranda, this is also to be tagged. This is also to be mentioned. And this is also to be addressed by the how he is going to address the prospective resolution applicant. If a BG expires without invocation, Nobody, that a particular, we have given the bank guarantee during CIRP, that whatever the expiry date, before expiry date, no, or claim period, no, the margin money returns to CD. CD means the estate falls under the IRP control. So the bank has to return that particular margin as well as whatever it is there, the security. The RP should not prevent invocation, cashback at BGs as a margin money generally not covered under market. The RP's role is include recording claims, including contingent events. Contingent liabilities are also he has to record. No, today it is not liability. Why should I record? We should not do that one. It is a contingent liability. And if at all during expiry, if during CIRP, if at all it is expired without invocation, then you are asking the margin money also. In that case, the contingent liabilities are also to be recorded. This is also to be mentioned in the information memoranda. This is also to be addressed by the prospective resolution applicant to the resolution planners. And ensuring bank guarantees are handled according to legal principles during the CIRP and in the final resolutions. So we have to ensure. That's why I told all these things in detail. First, you have to understand the concept. Once you understand the concept, addressing this one is not a difficult one. Not a difficult one. What is meant by counter guarantee? Sometimes counter guarantee. Suppose the subsidiary company, they are giving some guarantee and they requested some guarantees. Parent company or directors, they have to give the guarantee for the guarantee. That is called counter guarantee. For that particular guarantee, if at all any corporate guarantee or directors are given guarantee, then it is called counter guarantee. They have given margin of 50%, remaining 50 is unsecured. For that, I will take a counter guarantee. That is a must. So, in Indian banks, counter guarantee agreement to protect themselves. If at all it is unsecured, 50% secured, 50% unsecured means then the banks will incur the loss from the financial risk and ensure they are reimbursed if the primary guarantee is involved. Okay, 100 crores you are asking, 50 crores you have given the margin, remaining 50 crores, the parent company has to give the counter guarantee or the directors of the subsidiary company, whatever it is there. This risk mitigation strategy, where the bank's counter guarantee is from third party, such a central government or state government or parent company, or providing safety net against the possibility of not being covered under required. The counter guarantee in case of big projects, the state governments are also giving. Highway authorities, some central government guarantees are also given. So central government guarantee also some cases. State government guarantees are also given. Take for example, if at all they are importing some goods, in that case also, in addition to whatever the banks also will ask the company, if you give the government guarantee, then it is fine. So it may be the other corporate, or it may be the own directors, or it may be the state government in case of state projects, it may be the central government in case of central government projects. The counter guarantee is also very important in the guarantees. In essence, bank is securing its own financial position by obtaining guarantee against a guarantee has issue. So why Indian banks require counter guarantee? Risk mitigation. So whenever you are addressing this one also, for any guarantees, counter guarantees there or not, who has given that counter guarantee? Whether the directors are given or any other corporate has given or the central government or the state government, that also to be verified by IRP or RP or the liquidator. Risk mitigation. It protects the bank from the risk having to pay out on the primary bank guarantee without being able to recover the funds from the customer. Security for the bank. The counter guarantee is essential, back-to-back security. Once the bank is given guarantee, for that guarantee, the corporate guarantee or central government or state government or the directors, they will give the guarantee. This is prevailing in the infrastructure projects or big projects. Makes more secure when the issuing guarantee on behalf of the client. Reimbursement assurance. It provides a clear path for the bank to seek compensation from the counter guarantee if the primary guarantee is called up by the beneficiary. If the beneficiary is invoked, then bank will also ask the counter guarantee people to pay the amount. First, bank will pay to the beneficiary and recover the amount from the counter guarantee people. Compliance with regulation. The Reserve Bank of India often advises banks to prefer issuing secured guarantees, which can be backed assets or counter guarantee from strong entity like government body or public financial institutions. Even public financial institutions also, they will give guarantee. So here, being a IRP or RP or a liquidator, the guarantee, the counter guarantee, the beneficiary whom, what is a security margin, what is a collateral security, once it is invoked or not invoked during the CIRP, and margins are not to be taken, and even though during a moratorium, the IRP or RP should not touch the margin money. And once during CIRP, if at all it is invoked, then whatever the leftover balance is there, the financial creditor will claim. Or even at the time of the public announcement also, the financial creditor will submit a contingent liabilities. And during CIRP, if at all the guarantee is not invoked and the guarantee is completed, a period completed, then the IRP or RP has to ask the financial creditor to refund that margin money. And if at all any security is there, if invoked, whatever the security, first they have to appropriate the bank guarantee, remaining amount that is to be passed on to the liquidator in case of liquidation. And if at all the margin is there, the margin should not touch. And once the expiry is there, the margin is to be refunded to IRP. And once that particular security is there, the claim amount as well as security amount, the loan amount on account of invoked guarantee and the particularly security, both are to be informed to the IRP or RP. And in case of secured creditor, once whether he is invoking or not invoking, that is to be informed to the liquidator. All these things are applicable in case of the bank guarantees. Compliance with regulation. The Reserve Bank of India often advises banks to prefer issuing secured guarantees, which can be backed by assets or counter guarantee from the strong entities like a government body or public sector financial institution. Collaterals offered by CD to FC for guarantees during CIRP. During corporate CIRP, bank generally cannot sell the collaterals. If at all for guarantee they have taken collateral, they should not sell, because of moratorium section 14 prohibits any action to recover or security interest created by the corporate debtor. The bank must, instead of submitting the claim to CIRP, have right to determine through resolution plan also, which may involve selling the asset but not through bank's unilateral action. So all these things are to be taken into consideration. Moratorium halts enforcement. Once a CIRP initiated, moratorium takes effect, preventing the creditors from taking actions. This means the bank cannot simply seize and sell the collaterals. Bank becomes the financial creditor. The bank collateral is considered as a financial creditor. Their claim of the debt owed must be proceed through CIRP only. Resolution plan governed asset disposal. The final resolution plan approved by the committee of creditor determine how the corporate debtors asset, including the security interest, will deal with. And a resolution plan cannot provide for asset sale. The resolution plan can often does provide the sale or part of the corporate debtor, whether they are subject to security interest or not. All these things in normal loans, whatever the conditions we are following, the same is applicable for the bank guarantees, where the bank guarantees are backed by securities. Exceptions rare. While monitoring generally applies for law provides limited exceptions. For example, security already enforced, CIRP began, it might be treated, but it is not in the case of simply having collaterals. A bank as a security can sell the collateral security provided by the corporate debtor during liquidation, provided the following procedure outlined in the IBC. Section 52, particularly IBC, secured creditor, two main options. One is a bank can enforce its security to recover its debts and also identifying the assets. Any surplus funds must be go to the liquidator. In the reverse, alternatively, the bank can surrender the security to the liquidator and the part of liquidation asset where the bank becomes the secured and whatever the funds are there as for waterfall mechanism. The moratorium from the CIRP is lifted upon the liquidator order and must be within 30 days. All these things, everybody knows about this one. And they collate. In summary, banks has a right to sell the collateral security during the liquidation following the procedure under section 52. Further details section. So this is in brief about this one. Particularly to conclude this one, once the bank guarantees are there, cash margins for each bank guarantee is there. The IRP or RP should not touch during moratorium period the cash margin offered by the corporate debtor for the bank guarantees taken by him in favor of the beneficiary. If the loan, the bank guarantees are devolved during CIRP, the cash margin to be appropriated with the amount. If at all any shortfall is there, then the financial creditor can claim. Even at the time of public announcement also, the financial creditor mentioned about the contingency, this much guarantee issued, this much cash margin, this much security offered. Next, in case the guarantee is not invoked during the CIRP process, This is to be factored in the resolution plan also. That's why this information to be mentioned in information memorandum also. And once the development of once the guarantees are expired during the CIRP and no claims are there, then whatever the cash margin is there, that cash margin is to be returned to the IRP or RP by the banks. So this is in brief about that one. Like loans, today the bank guarantees are also increasing in the banks. So we have to address during CIRP or liquidation the bank guarantees also. I told about the bank guarantee, how they are issuing, how they are processing the bank guarantees, and what type of a margin they will take, what are the service charges they will levy, and what is meant by deferred payment guarantee. What is a performance guarantee? What are the financial guarantee? When the goods are received by the corporate debtor from the port for customs duty, or if at all any documents are not submitted, the port authorities will also given that particular, they will insist for bank guarantees. Not only that one, in the case of the infrastructure projects, the infrastructure companies are also number of bank guarantees that they will take. All are to be properly examined and all are to be properly addressed. This is not a difficult task also. But in the company also, in the balance sheet, bank guarantees are not reflected in the body of the balance sheet, assets and liabilities, but it is mentioned below the footnote of the balance sheet. And normally, like a shareholders list, debentures list, creditors list, debtors list, the companies are also maintaining bank guarantees list also. And if that is not available, the IRP or RP, they have to verify the ROC website also. Whenever the bank guarantees are issued by the banks, they will insist the company to register with ROC. If at all that is not registered by the company, normally that is a practice and charges to be created on the whatever the margin, whatever the assets are given. If they have not compiled, then within the company and particularly the banks are issued a notice to the company. After 14 days, again the bank has to register with ROC by providing this notice also. So this is a important process in CIRP also. Particularly if loans are 100 crores, normally 40 crores worth of guarantees are there in most of the companies, particularly infrastructure companies. Next, in the similar manner, foreign guarantees are also there. That is also to be addressed. That is called a letter of credit, foreign guarantees. That is a UCP DC 600 brochure. But bank guarantees are governed by Indian Contract Act. But foreign guarantees are different. That in next, particularly tomorrow, the debtors class is also there. How to address the debtors or account receivables or commercial papers or factoring or forfeiting or trades, TREDS, trade receivables discount. These are also assets. Only assets means not a plant and machinery building. The assets, the margin money of the guarantee is an asset. The security offered to the guarantee is an asset. At the same time, liability is also there. But in the similar manner, the debtors, the bills discount scheme is also there in the banks on the debtors. In the debtors assignment, the clause is also there. How to address? What is the credit policy of the company? All these things Tomorrow I will discuss in detail like bank guarantees. Any doubts, sir? Any doubts?
No, sir.
Okay,
It was
sir.
a useful presentation, sir, and very elaborately presented.
This presentation
I am
also I
thankful,
have
sir.
already sent to Madam, sir. Madam will circulate it to all the people, sir. Today presentation and tomorrow's presentation also well in time I have submitted to Madam. Okay, sir?
Okay, sir.
Ah,
Thank you, sir.
thank you. Good night to all, sir. Good night to all.
Thank you, sir. Thank you.
Thank you, sir. Thank you.